So today we're going to talk about fintech, innovative solutions, with the idea to, on the one hand, reach more end beneficiaries, but also maintaining profitability. So I think that's an interesting trade-off. And talking about interesting, I think this is an interesting panel and arguably maybe the most interesting of the conference, but I'll leave that to the audience to decide. So it's a panel on banking, and I will introduce the panel. There are a lot of bankers, I realized. So I'm not a banker myself. I partner with banks. I always wanted to become a banker, but then I lost interest. Okay, maybe without any further ado. So who do we have on our panel? We have Wayne. Wayne is the founder and chairman of 4G Capital. 4G is an award-winning neobank in East Africa. And living myself in Nairobi, I can confirm that 4G Capital is one of the better-known fintechs. Then we have Chuma. Chuma is the head of strategy at AFSIC Bank Group. And in that capacity, he leads the group's investment and funding activities across Africa. Then, and sorry, I think is it Frederick, right? Yeah. Then Frederick, the CFO of CRDB. Again, living in Kenya, CRDB is arguably...
Tanzania.
I know, but I just wanted to say that we all know our CRDB very well, one of the bigger banks in Tanzania. And then last but certainly not least, Suleiman, the Chief Investment Officer at Equator Capital Partners, a private equity firm that manages the ShoreCap family of funds. And indeed, Suleiman, you are a banker too, right? Because previously you had some leading position at HSBC and also CDC, now better known as BII. Okay, so let's start the panel. I've asked all the panel members to first give their perspective on the topic from their point of view. And after that, we'll circle back. And I'm sure I have a couple of interesting questions for the panel. And then finally, we can end up with a short Q&A. Wayne, do you want to start?
Well, thank you very much. Thank you, Olivier. Thank you, my brother panelists. Thank you to the whole AFSIC team for yet another fantastic event. I'll be brief about what we do, because really the conversation is the important thing. But we are growing business with capital and knowledge. 4G Capital is a neobank that provides working capital blended with enterprise training to micro and small businesses in Kenya and Uganda. We've been going for 11 years now. Our clients, who are really my constituency and who I am here to represent today, are 80% of Africa's GDP and the absolute rock and foundation of the economies and the societies which we are privileged to serve. About 80% of our customers are women, and with our help, they grow their revenues by an average of 80% year on year. So that's what we do. The innovation within the space, I think, is extremely exciting. It's been going on for some time. Fintech is no longer a new or a dirty word, but there's still a great deal more to be done. The finance gap, currently about $500 billion in Africa, about $10 to $20 trillion worldwide for the micro and SME lending space, is expanding, not contracting. And these are the people that we need to serve. So we need to make sure that this technology is being applied mindfully, designed around the customer's need, and is there to help them create value, help them to access wealth. We don't want to be just shoving debt at people like factory chickens or something like that. We need to be enablers of prosperity. And so I'll leave it there and look forward to the conversation.
Thanks. Chuma?
Yeah, a lot of us in the room will be familiar with Access Bank, which is the largest bank in Nigeria. But I'd like to start by perhaps highlighting that Access Bank or Access Group is really no longer just a bank. About 2 years ago, we metamorphosized into a holding company, financial services holding company, offering more than just banking. So we offer insurance brokerage. We have the second largest pension fund asset manager in Nigeria. We have a consumer lending business, which is completely digital. And finally, we have a payments business which is increasingly becoming the leading payments platform, payment service company platform in Nigeria. We've grown significantly beyond the shores of Nigeria. We're present in what is almost 15 African countries. We've been the busiest financial services platform in Africa when it comes to inorganic expansion over the last 5 years. You would have seen us, not just enter the Kenyan market, which happened in 2020. We've consolidated further in that market with 2 M&A transactions announced between then and now. We're going into the Ugandan market. We've strengthened our franchise inorganically by entering Botswana. We're in Angola. In fact, we've done 2 deals in Angola, the second, which was the Standard Chartered acquisition that closed just last week, Friday. So we're a significantly growing financial services platform that is really evolving beyond banking into providing a holistic, one-stop shop financial services ecosystem for customers. We really pride ourselves in a situation where a customer comes in and is able to access all their financial services needs through access, no pun intended. Thank you very much.
Thank you. Frederick.
Thank you. You are aware of CRDB Bank. CRDB Bank is the largest bank operating in East Africa. We are based in Tanzania as the largest bank. We have a subsidiary in Burundi, which is now the most profitable bank in Burundi. We last year extended our service in DRC Congo. We have other 2 subsidiaries operating in Tanzania, CRDB Insurance Company, which is focusing on the insurance business. We also have CRDB Foundation, which is focusing on financial inclusion, mainly looking at the women and the youth, which is actually the highest financially excluded segment. You are all aware the level of financial inclusion in Africa. In Tanzania, it's standing at 22%. And particularly when you look at the segments, the women and the youth are the most which are left behind. We have leveraged on the innovation. About 56% of our non-funded income is coming from or powered by the innovation and the digital transformation initiatives we have been implementing. Thank you.
Thank you. Suleiman?
Okay, thank you very much. I'll be very brief because a lot of information I'm sure you can find on the websites and different places. Equator Capital Partners, we manage the ShoreCap family of funds, which as an impact investor primarily in the financial services sector in Africa, Asia, and emerging Europe. As was highlighted, I've also served at BII as the Regional Director for Africa, and I think through that interaction it is interesting that I realized that I've either invested in or been directly involved in all of the institutions here. Maybe just shifting then to the actual question, and I think that's where really the interesting conversation comes through, is I think we all know that if you're going to increase profits, there's really 3 places to do it. It's either scaling your business, improving efficiency, or introducing new products. So I do think that if we retain and focus on that, I think that gives us an interesting element of, well, which elements of those can we work together with and where can you be independently accountable? I think obviously the other key element of this is where you have innovators, what have you, is capital. And I think we then also need to understand the interplay between capital where you have the innovators and what I would like to call the interpreters who actually interpret innovation to the aggregators or basically the people who actually hold the capital. And I think that if we sort of frame it in that, I think maybe we might have quite an interesting discussion. Thank you.
Okay, thank you. Yeah, because if we talk about innovation, of course, and efficiencies, then one topic always comes up, which is financial technology, having, I guess, less and less client contact. As far as I can see, having a contact with the client is always very important, especially in banking, know your clients. So I just wanted to ask the panel, how do you see that going forward with more and more technology being implemented and I guess less and less client interaction? to what extent that is a risk or not. So I'll let anyone wants to start off.
I'm happy to start.
Yeah.
So you know, the concept of customer interaction in banking, I say, broader financial services, is an interesting one because ultimately, customers want focused interactions with banks or financial services companies more broadly because customers have other important things to do, right? Besides, you know, queue, for example, in a bank branch or, you know, spend countless hours trying to fill in an application, even online. What I think is exciting, and it's not just in the financial services space, but I think it's particularly exciting for the financial services space, given that background, is that particularly with the advent of AI, banks or financial services groups like ourselves are able to really have much more targeted and focused engagement with customers. And that's not just through service channels. You have to actually go a few steps back into everything from what is even the product set that are presented to customers. Because not every customer is the same. Not every customer wants you know, the same set of products or has the same set of needs. Through just leveraging, you know, data and artificial intelligence, banks like us, and we're already doing this as Access, we're able to actually have very targeted and specific marketing campaigns. So it's sort of getting the customer through the door in the right way, in the most relevant way, and then engaging that customers at the right intervals, again, leveraging artificial intelligence tools. But it also goes just beyond, let's call it, you know, getting customers in and serving customers. It's also, you know, frankly, improved significantly. You talked about KYC and just the broader compliance framework. I mean, financial crime is something that has been a big problem for banks across Africa. I mean, you hear from, and even just not banks, payment companies from time to time, you know, lose quite large sums of money. Again, leveraging AI, I think there's a tool here, maybe some of the bankers will be familiar with, called Black Forest. Just leveraging tools like Black Forest, we're able to significantly reduce incidences of financial crime or incidences where banks are not able to recover proceeds from financial crime. And then coming back to the KYC and compliance bit, again, as we onboard these customers, again, leveraging technology, we're able to screen out bad actors a lot more efficiently. Banks are also able to monitor, leveraging technology when there are suspicious or transactions that are unusual. And again, leveraging technology automatically put those transactions on a watch list that then gets reviewed by an individual who then makes a judgment call. So I think technology, AI, and everything around that is really just transforming both the onboarding, the customer engagement, and some of the compliance and frameworks, which are fundamentally important to ensuring that the customer is served, but also the banks can make money from those customers in a way that is sustainable and doesn't create longer-term issues, you know, fines and whatnot.
Okay, Frederick, how do you see that?
It's quite exciting and interesting, and maybe I wish to give the perspective from the African side, where the customer onboarding has been a challenge, the KYC has been a challenge, and onboarding these customers initially would require someone to travel a long distance or the customer to come long distance to get the financial service. Case for CRDB, for example, where we leveraged on strategic partnership and integrating the systems. And we rolled out the customer onboarding solution through the mobile, using the bio, whereby the customer can do the self onboarding using his bio on his mobile. But that is actually leveraging on the customer national IDs being available on the national ID database. That has scaled up our level of customer onboarding. Quite interesting and exciting. We realized the level of the volumes when we translate on the number of customers accessing the financial services. 97% of our transactions are happening on the digital touch points. And when you look at which time do they happen, they happen at night. 40% of the total volume happen after the closing out of the normal banking services. So you could see how much it scales the level of access and financial inclusion. But the setback is the more you innovate, you open up windows for the bad guys out there. The cybersecurity is becoming key. And I believe this is one of the discussions that I would be interested to hear. Good to hear that at least the AI is addressing that. But in Africa, as we continue to innovate, you see increasing level of the cybersecurity. Customer needed to trust the financial services. They need to be secured. We have seen the customer data protection regulations coming across. And we see more complication coming up to ensure we protect the customer.
Yep.
And I would wish the discussion to scale up to that level.
Yep, absolutely. Couldn't agree more.
Yeah, Wayne, how do you see that? The representative of the fintech.
Yeah, sure. So I guess the first thought that comes to mind is that our purpose, why we exist, is to confer value to our customer. Okay, and that's how we make money and confer value to our employees, to our shareholders. That's why we're a very proud B Corporation, a benefit corporation. It's a global movement that is the highest standard of ESG measurement worldwide. Our firm belief is that you're not trading money for impact. You're making more money by being impactful and looking after your customer. It makes you a better business. So coming to the exam question, how this innovation really applies and where is it going, I want to kind of keep banging the drum. Design around that customer problem, but also to be a better business. So I loved everything that you said. Once you digitize, you are in an arms race, because you now have a different attack surface for bad actors. And this is not an African problem, for the avoidance of doubt. This is a global problem. And many of the people who will be trying to attack our fine institutions and our glorious customers will be coming from outside Africa. So this is the world we live in. So designing for security, designing with those best practices is extremely important, as is the regulatory framework. And conversations like this would be quite handy to have some regulators, some representatives from the governments of the countries that we serve, not as adversaries, but as collaborators, because we need to support one another. We need a regulatory framework that protects the customer, but it then needs to be enforced. There's no point of jumping through all the hoops as we have to get your license and all the rest of it, if all the rest of the unlicensed operators continue to be allowed to practice and are not in the crosshairs of the taxman, and are not paying attention to cybersecurity or to data protection or the rest of it. So it's a really, really important conversation that we do need to have an operating environment where we can succeed. And then I guess kind of wrapping up that final bit about automation, we're a little bit of an odd duck, I guess. We keep a human being in the loop, and we really believe in that. We don't believe in robots, we believe in cyborgs. We use our technology to augment and enhance our employees and our customers, to guide them on their journey from informality to formality, to being part of a digitally integrated economy in Kenya and Uganda. It's a walk, not a sprint. We've got to do it in the right way. But we have a hybrid approach. So our customers have a human relationship officer, or indeed two. And I'm sure any UK banking customer here over a certain age can remember the moment when your local branch shut and you couldn't speak to the bank manager anymore, and you couldn't speak to a relationship officer, and you found yourself at best speaking to an Indian call center who do a great job for what they're paid to do. It's not the same. It's not the same. So financial services are inherently very sensitive. Okay, if you get them wrong, it's disastrous. Get it right, it is transformational. So we like keeping a human being in that relationship, but we like them becoming more efficient by designing that technology to leverage access point and scaling. So I think with AI, you can design a digital customer journey that gets you very, very close to a really good personal service with a well-designed chatbot with a large language models using various technologies. So we're still big fans of people. And I just will keep emphasizing the point to design mindfully and responsibly your technologies.
Okay, thank you. Hey, and maybe for Suleiman, you being an ex-banker yourself, and now maybe with working for a PE fund. So if you would be looking at investing into a bank, obviously nowadays I guess everyone is looking for banks that indeed apply or implement more innovative solutions. But then you also look at profitability-wise from an investment perspective. So what is there the trade-off you believe?
No, thank you very much. Interesting question. I would say that, and I guess we come from it from a different perspective in the sense that we are impact investors. So yes, we want to make money, but we also want to make sure that we're having strong impact, and particularly on the matrices that we've identified as being important, which is really your financial inclusion. And when we talk about financial inclusion, it's not just saying, hey, you have access to financial product, but also the depth of that product. Because I know many people now say, oh, I get a bank account, but if the person has a bank account where they get their salary in the morning and they just basically drain it by the end of the day, and then they're now figuring out what they're doing for the next 29 days, that's not really advancing the financial inclusion perspective. So we do try to balance off to make sure that how do we leverage both of that. And I think it's interesting from the conversation that we've had, that I'm hearing here, is that people have talked about the inclusion, they've talked about impact, and they've talked about customer. What I would say is that when we're looking to invest in institutions, we look at those institutions that even though we have technology, which is allowing us to commoditize, we have to recognize that particularly in Africa and in our developing markets, people's ability to create an appropriate digital profile is not always easy. And so you have to be careful that you make sure that your tools are not just giving information, but actually knowledge. You're actually learning and understanding who your customer is so that you're actually tailoring it to it. Because, I mean, simple things is, and I know some people have found this, where you get into a KYC situation in Africa, particularly because of the way our names are, and then someone just suddenly says, KYC, you're so-and-so. And then you have to spend hours proving that because there's a transference of names or what have you, you're a different person. And so these kind of things become very critical to understanding, well, as you're constructing your product, as you're engaging with your customer base, are they appropriate to reflecting the human aspect of it, which is where I think even on this panel you can see Wayne's talking more about the human interface and appreciating it from the customer side, whereas as you get to scale, you start looking at it more from the number side, because you've just got huge client bases that you just have to manage around. And I think that's where the balance and the interaction between fintech, which creates structured, appropriate solutions that then can be adopted by the banks so that we are collaborators. We're in competition, but we're also collaborators. I think that makes us for a much better banking environment in general and more profitable for everyone.
Yeah, thanks. So, sorry, Chuma, you want to?
I do.
Because I also wanted to discuss a topic of, and now that we have two representatives of a bank, we have a fintech representative, to what extent these institutions can actually work together, complement each other, or maybe not. So that would also be interesting to hear that perspective.
Yeah, so the starting point is banks have been unfairly treated when it comes to growth capital allocation, particularly in the last half a decade plus. Most of the capital that has come into financial services in Africa, I'm talking equity, risk, real risk capital, I'm not talking tier 2 and senior debt, which tends to be the preference for banks these days when it comes to investors. Most of that capital has found its way into institutions that call themselves financial technology. You said something about it's a walk, not a sprint, but frankly, the capital has bolted or sprinted away from banks. And that's a real problem, because when you actually look at the makeup of which institutions have the most customers, which means have the largest propensity to deliver the impact and the transformation that's required, it is still by a million miles banks, right? A bank like Access Bank, 60 million customers. The largest fintech in Nigeria, I don't want to quote any specifics, but I imagine would have somewhere less in terms of real number of customers that interact on their platform day in, day out. But when a bank, or when banks in general are starved of capital, it limits the ability for these banks to actually make significant strides in innovation. So what's happening is, customers are not getting full service from banks when it comes to technology, so they almost have to pay. But again, the banks are just much better positioned to innovate because they know the customer, they have the data, etc. Now, of course, we'll talk about partnerships and all those things like that, but I did want to make it very clear that I think time has come for a rethink in terms of the funding, the valuation gap between banks and fintechs, because I think it's fundamentally, on a long-term basis, inhibited the growth of banks really becoming significantly transformational when it comes to deepening financial inclusion and all those other things, because the capital is just not available. If you look at the amount of money fintechs have raised, again, in that same period of 5 to 10 years, relative to banks, I'm talking about in fresh capital. I mean, God bless the Central Bank of Nigeria for forcing banks in Nigeria to actually raise capital, because it was becoming a real issue. The valuations are so low that people don't want to go out and raise equity capital because it's too dilutive. Whereas for fintechs, I mean, many of them are raising capital at 10 times price to book. Infinite PE ratios because the business is actually not profitable. So when you just look at, the differences in treatment, it begs a fundamental question: is why not invest more in helping banks transform digitally, as opposed to taking all that capital into new players that are unproven and haven't really demonstrated their ability to transform, lives in the way that banks have done, albeit traditionally, but increasingly digitally.
Yeah. Interesting, Chuma. I don't know, Frederick, and then we'll give the floor to the fintech representative.
Quite interesting discussion. When you look at the innovation in the regulation, often you realize very challenging, maybe, angle of thought. Much as the commercial banks and the financial institutions would be looking at the innovation, but often they found themselves on a trap of making sure that they comply. Unlike the fintechs and the mobile network operators, the regulation out there is a bit favoring the innovation. So most of the fintechs and the mobile network operators found them ahead of the commercial banks in terms of leading the innovation. But what we have found working is engaging the regulators. The case in Tanzania, where we have been engaging the regulators and we have been able to see more conducive, innovative environment, whereby we discuss with the regulator, the central bank, to try to look at the hurdles and look at the way we can work around to provide appealing solution to the customers. So I'm just looking at whereby we are working now as partner. Initially, you found commercial banks who are working like competitors with the fintechs and the mobile network operators. We see more of partnership engagement today, and that is scaling the level of innovation and the solution. We have seen more opening up of the systems, more integration, setting up the stage for regulation for the systems to shake hands, which is creating the room for the commercial banks and the mobile network operators, and the opening up of the IPs, the fintechs coming to the banks. That is scaling the level of innovation, but also opening more opportunities for better customer service to the market. And I believe we would see more of the regulators being more proactive in areas where regulators have been ahead to put the environment for innovation. Take an example of Brazil, for example, with PIX. You could see how it has scaled the financial inclusion. In Tanzania, we are now integrating all the payment systems and opening up for the mobile network operators, commercial banks. And that's going to scale big times the financial inclusion and the access of financial service to the customers.
Yeah, it's fascinating. Well, I guess I'm learning a lot. The market's the market, right? There's a lot of things we don't like about where some of that sentiment is run. You know, we got our backsides kicked because we were prioritizing profitability and sustainability over mad scaling and growth. And there was a time when the venture capital community didn't want to say that. I mean, I won't name them, but dear friends of mine in the VC world are going, forget profitability, grow, 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 grow. These guys have got 9 million customers, and that's what we want to see if you're going to get this valuation, and we want to invest in you. I think, but, I mean, I'm no guru, but doesn't being profitable mean that you can kind of pay your people and you're not raising money to survive and then COVID hit and everybody got very, very concerned about profitability and resilience and having the kind of cash reserves. And we, by the grace of God, we got through it, and our wonderful customers, and we had some very good investors as well. But market sentiment is market sentiment, and I guess the only thing that you can do is to lay out how and why you're creating value and just stick to your guns. It hadn't really occurred to me that banks were suffering from a lack of investment, because the perception is that they are so large and powerful and profitable already and sitting on such a lot of incumbent advantage that they could kindly, they could innovate more if they so wished. But what I'm learning is that, of course, the challenges are there, all the responsibilities are there. And I am firmly against the thesis of fintechs versus banks. I've never bought into that. We all do different things, and the way to create mega value is to work together. So banks should not be doing high-risk venture lending. They are there to steward their customers' savings. You want banks to be conservative. You want banks to be responsible. And when they go adrift, just look at the West in 2008. That's not funny. That's not funny at all. We're still paying the price for that, let alone COVID, let alone the wars that are going on now. So when we get it wrong, it's really, really bad. So I think that banks are very good at doing what banks should do, and fintechs solve a slightly different problem. And by fintech, I mean we're an unsecured lender, so we provide unsecured, very fast loans, but we do it with laser precision just for growing small businesses. We work with fantastic banks in Kenya. Fantastic banks. I'm going to pay tribute to INM, fantastic partners. Cooperative, fantastic partners, okay. And I think that by complementing each other's strengths and by working together, because of course we need local currency debt, because like every other MFI, we've got too much dollar debt, and that's just a barrel of laughs when the currency takes a correction, which means you have to hedge, which makes things more expensive, which means that our prices are higher than we want to be. Enter the impact investor who say, oh, you're far too expensive. Yeah, we know. Help us bring our prices down by giving us access to lower cost of capital. Yeah, but how profitable are you? Well, actually, we're profitable. Oh, well, that's good. So on the conversation goes with the same circle of pain. And I think that, where we're all coming to a very interesting alignment, and we should definitely go to lunch together, the four of us, is how we can work together to leverage our relative strengths to maybe create a super value case where you can get the Silicon Valley money you obviously want.
Absolutely.
And I can get the local currency debt that I need.
For sure. Yeah. So, I mean, and I think that's a great sort of segue where you've come from, because I think, as you say, the market's the market, but everyone's perception of the market is based on their own sort of unique circumstance. So Chumi is saying, well, there's no capital. I mean, I would push back a bit and say there's not a lot of the transactions go into the VC, but if you look at the sort of value that is actually invested, and you're saying, well, one transaction that goes into the bank is maybe 1,700, whatever, of the VC. So I think that's where, from the perspective, it's like, well, they don't love us, but you're getting quite a bit of the chunk of the love. Whereas I get, you see Wayne there sort of saying, well, how do we interact? What I would agree is that where you have that intersection where you work together, and I mean, you mentioned INM, I chair INM in Uganda, and so maybe I'll use that as an example, is we find that it actually benefits both parties. So if you take like a Watu Credit or Tugende, because I don't want to use you, for instance, where these are guys who are supporting sort of financing to motorcycles at low end. They create a product, they're struggling because they've used equity capital, what have you, to do it, but then the banks step in to say, okay, let's refine that product to make it more bankable and what have you. And today, if you look at those two institutions, their funding comes more from the banks than actually from their equity partners.
Yep.
Again, if you look at sort of partnerships, and I think that's where it is that you take an M-Pesa, which is the classic sort of partnership element, is that if you see the way that initially the banks tried to engage with them, an equity bank, and sort of look at them as competition, and it really did not serve anyone's purposes.
Yeah.
But the reason why equity has actually, one of the reasons it's grown is because two of the larger banks say, you know what, actually let's embrace this.
Yeah.
Let's create a co-branded product to really drive lending, innovation, and what have you. So I do think that yes, we are going to be in our unique corners every once in a while, but I think when we look up and sort of see what someone else is doing and say, well, how can we piggyback off of that so that we're both doing well out of that innovation? I think that's where we will really start to see sort of real genuine change in our markets. And I will say fintechs generally are better positioned for that innovation, and then the banks are genuinely better positioned to scale it in partnership. Thank you.
Okay. Thank you very much. Very interesting. I think we have 2, 3, 4 minutes left. I would encourage the audience to ask any questions or have any comments. And before doing so, you will get a microphone. So just wait until. But it would be great to get some feedback from the audience. Thank you.
Very interesting. Thank you, gentlemen. Principal question I have to ask is, increasing banking profitability in Africa. When you look at many of the balance sheets of African banks, or the segment analysis, it is much toward the retail side. When you look at it, there is very little in the way of mortgage lending. So it comes down to many factors. One, title deeds, because since you don't have title deeds, you don't have collateral. Therefore, a bank can't lend. If a bank wants to increase its profitability, if you can get a client for 15, 20 years, hey, bingo, makes cost of acquisition of clients much lower. Your comments, please.
Anyone?
Yeah. So one of the reasons, one of the main reasons why when you look at developed markets, I'm going to use the US model as an example. One of the reasons why the mortgage market, as well as mortgage lending in the US has thrived so much is particularly because of the strong backing of capital markets, specifically the linkage being securitization. In many African countries, I know I speak for Nigeria, but also some of the ones actually that we've invested in, the frameworks, the legal frameworks, maybe back to your point, have not sufficiently developed into catering properly for the right level of capital market securitization. Ultimately, banks want to lend, but banks also need liquidity. Mortgages tend to be very long-term, right? And the funding for most banks tend to sit in deposits. So ultimately, there's just a fundamental mismatch between taking deposits that are either current account, savings, maybe fixed deposits for 1 year, and then you're lending on a 20-year perspective, which is what most mortgage loans or most mortgage borrowers would be looking for. So I think in the absence of a proper securitization market where banks are able to turn long-term loans into liquid assets, and the US has gotten that right, primarily due to not just having the legal systems in place, but government support through the GSEs, the government-sponsored entities being principally Fannie Mae and Freddie Mac, who've really stepped in. They buy the mortgage loans from banks. They turn it into securities that have this implicit government backing. So, the banks buy them back as much as possible and classify them as AA or AAA rated securities on their balance sheet. I know you don't like 2008. So I think that market just has to naturally develop. Even in the US, it took a long time. Sometimes when we look at Africa, we forget that even in the more advanced markets, the concept of time and development go hand in hand. So I think we will get there, but ultimately the regulators, government institutions need to take a more proactive approach. The good thing is we don't have to wait as long as developed markets because we have the model, right? Just the same way we transformed fixed telephony into what is now GSM services, and everybody having 2 or 3 mobile phones. I think we can do that with financial services, but it does require the government to step up and support capital markets innovation.
Yeah,
Thank
maybe,
you. Frederick, yeah?
I would like to add on this one. One of the hurdles in the African markets particularly is coming from the formalization of the mortgage market. A lot of land in Africa is unsurveyed, and that brings one of the biggest challenges when you look at the developments and the challenge the developers face and the banks when they want to enter into that market. But the other hurdle is the affordability in terms of how many of the market percentage can afford, even those which are developed. And that is key. Players to come in, inject capital for affordable housing. That's one where big developers needed to come in, and the impact investors needed to inject in capital to make sure that it happens. Again, capping on the regulation. When you look at in the African market, some of the incentives are not working, and that's where we needed to look at the regulators to make sure that they plug in the incentive to attract more investors.
Thank you. Thank you, sir, for that comment and question. Anyone else with only a couple of minutes left? Anyone else?
May I just add to that last question, just very briefly, but I think you very subtly alluded to the greatest pain of the world, but which affects us perhaps disproportionately in Africa. The confidence in title deed is what is the inhibitor to mortgages. I suppose that is a part of the wider problem of wastage, of confidence in rule of law, of structures that allow businesses to take risk. And I guess I'd just sort of say that Africa has a leapfrog opportunity which is so often used and misused, not just in terms of technology or financial services, but to design African governance solutions which solve African problems. Do not emulate the West with high tax, high spend, low productivity. Do not emulate the autocracies with monolithic control of power and total mafia states. Let governments be the ultimate enablers for businesses to solve the social problems which are so important, which will serve the needs of the most important continent in the world. By 2050, which is a blink of an eye, 1/4 of humanity will be African, and 1 in 3 working adults will be African. This is the market for the West and the rest of the world to get behind. It's the market for Africa to get behind. There's huge amounts of capital already in Africa. It needs to be put to work with the confidence to know that the returns will happen, and that means the confidence that the corruption space will be driven out by enabling governments, and governments don't need to solve every problem because governments are not great at solving problems. They're very good at setting conditions, and businesses and people can solve those problems. So I just wanted to add my remarks to that question.
Okay. Is there any other question or comment from the audience? No? Sure? Well, I think it's also time. So let me thank the panel. I think we had very interesting discussions on the innovative solutions in the trade-off with profitability, and also which arguably with 2 representatives of a bank and somebody at fintech. Interesting also to hear the panel's discussion about how banks and fintechs can work together or not, but I think they can definitely work together. I think that's clear. But I want to thank you all, especially the panel, and wishing you all a great day. Thank you.
Thank you.